Well, let's shift focus to the IT space then. JPMorgan says channel checks suggest no signs of spring in the Indian IT sector, and they prefer defensives with high growth names. Ankur Rudra of JPMorgan joins us on the show. Hi, Ankur. Good morning, and always good to see you in. Well, tell us first up, how do you approach the tech space, and what do you like and dislike?
Hey, thank you. Good morning, and thank you for having me. So we think the IT services sector continues to see, demand uncertainty. This is the uncertainty that sort of percolated and persisted for over, 6 to 9 months now. And there is no clear sign of demand recovery momentum here. I think what we are hearing and seeing is that the underlying demand trends remain relatively unchanged and subdued. Companies continue to see larger contracts, which are very cost-saving oriented, but also to an extent driven by vendor consolidation, drive the action in the market, whereas shorter cycle deals continue to sort of miss in action. We are also sort of seeing the industries which were previously healthier, like the auto, aerospace, travel, etc., continue to do well, whereas sectors such as TMT continue to be under pressure. The one change we do see, however, is financial services looking a bit more healthier than before. So I think that might change over calendar 24. The other thing we also see, to an extent, a pressure point on the industry tends to be insourcing, and that sort of is driving the pressure on the sector. So in this context, what we like is we have taken a barbell approach to the sector. What we basically are telling investors is either go for defensive companies with which are higher quality, give you a huge amount of dividend or buyback support, or go for companies which will give you relative amount of outperformance over fiscal 25. So those are the two sort of ends of the spectrum we like.
Could you get a little more specific on what those two ends of the spectrum would mean in terms of a couple of names?
So we're not allowed to name, as you know, but as what you can see among these stronger growth companies, we are seeing some of the mid-cap companies are growing a lot faster. The larger cap companies continue to struggle on an overall growth perspective. So you've seen the NASSCOM number last year. The industry growth was sort of low single digits. So we don't think at the moment we will see any meaningful acceleration from that. So companies which have that kind of a growth profile, but also give you dividend support, are the ones we like on one end, and the companies which can outperform the sector growth. And some of the names probably are similar to last year, which is what the other end of the spectrum we also like.
Now, the reason why I ask you is largely because, this morning there was a deal that came in for HCL Tech. Wipro's looking at some sort of AI foray as well. Over the last 12 months or so, Infosys and TCS are up around 16 to 19 odd %. So when you say stick to quality names, so one end of spectrum, I presume, would imply some of these names. And the second end, which is basically high growth, which according to you is outperforming here?
So like I said, among the larger companies, among the large cap companies, we haven't seen meaningful differentiation of growth for a while. Many of the names you mentioned were sort of growing in the region of the NASSCOM growth rates. And we really don't see a meaningful change either within the names or within the large cap sector pack. So only companies where the dividend yield is reasonable, let's call it, close to mid-single digit dividend and buyback yield is reasonable. That's one end we think is where investors might be protected on the downside. And on the other side, with companies which are growing, let's call it, double digits and above, which is about 10 percentage points ahead of the large cap peers. Or let's say on a 2 to 3 year basis, earnings growth can be either 10% or revenue growth can be 10% ahead. I think those are the two ends of the spectrum we like. I'm sorry, I can't get more specific.
Yeah, no, fair enough. Ankur, now Prashant here, morning. Because we are in a situation where participants and investors that we speak with are generally of the view that index level valuations are not crazy, but some of the hot areas valuations are very high, so it's kind of tough to find new ideas. There is no real sign of a recovery in IT services. We got that point. But do you think if one were to kind of hold on, buy some of these IT names, and we have the reports, we'll put out the picks, you can't talk about it, understood. But if one were to hold these on for a few years, right, extend the holding period, isn't that make sense? There is a margin of safety here in some of these names, IT services. And given enough time, one will make money, decent money?
Yeah, I think what you've seen is if you look at the IT sector, right? So IT sector is sort of, underperformed so far this year. It's about IT index is about 8% below the Nifty. It's broadly in line over the last 1 year. It's underperformed on a two-year or a 3-year basis. So then you have to go back all the way back to 5 years to see IT, or 4 to 5 years to see IT sector outperforming, which is basically during the beginnings of COVID. Now, what we are seeing in demand in the sector is, and why growth is not really coming through, is enterprises had significantly overinvested right after COVID, and that's still being digested right now. We are in the second year of, call it, technology spending recession, if you will. And typically this phase does not last for a long time. We don't think enterprises will be able to not spend on technology beyond a few years' time. Now, there are a few potential clearing events from a tech spend perspective, which can potentially drive performance in the sector. One of the events we continue to hear from our industry conversations is potentially, after US elections. The US presidential elections have been a source of uncertainty, which is adding to a potential softness, a continued softness this year. Also, the lack of rate hikes so far that was expected most of this year, a lot of enterprises are using that as an excuse to not spend. So if any of these two clearing events, or if not both, play out over the next 12 months or so, I think that can really help the sector. There's also a lot of conversation about generative AI, how that impacts spending priorities, and if IT services spending is getting reprioritized as a result of that. So if any of those debates are settled, we'll tend to see performance. So, and hence, I think there definitely is an element of, I would say, defensiveness in IT companies, especially if you look at multiples now versus pre-COVID, they're slightly different, but mainly supported by dividend yield. And hence, some of this high-quality dividend yield supported names look, I would say, defensive, and look where the margin of safety is not very low, I would say.
So that's a yes. To my question, Ankur, that's a yes. You will make money if you buy and hold and wait, because it will turn. That's what I made out from your answer.
Yeah, what I would say is, in the short term, we are, I would say, circumspect of demand. In the medium to long term, we are optimistic.
Okay, all right. So you got to have time on your hands, time on your side, to be able to wait really as things come through. Ankur, we'll leave it there. Thank you very much for your time here on CNBC TV18. A good conversation as always. And we'll have you back on with the next result season, which is never too far away.